Hello guys, welcome to the second part of this video. The first part of this video we talked about a simple trading strategy that can make you profitable as a trader. In the first part of this video we looked at the different candlestick patterns that can give us signals on either to buy or to sell in the financial market. So today we'll be looking at the second part of this video. If you could recall, during the first part we said, in as much as these candlestick patterns serve as confirmations, we need to look for them at certain zones in the market. So today we'll be considering those zones, and whenever we get to these zones and these candlestick patterns forms at these zones, then we make entries. Just like we said, this is a simple trading strategy. We are not bugging with a whole lot of concepts, ideologies and all that, so that you don't end up getting confused as a trader. Follow through the course of this video, and if you've not subscribed to this channel, please do subscribe and also give this video a thumbs up so that it can get across to a whole lot of traders out there. Who knows, you could be helping a struggling trader. So follow through the course of this video, get your writing materials ready, and again, do not skip any part of this video. Do not skip any part of this video. It's important that you follow through all the explanations that are made on this video, because definitely it will be for your own benefit. So follow me as we go into the chart so that we can look at the various zones where we need to look out for the candlestick patterns that we considered during the last video. I hope you've not forgotten. During the last video, we talked about two classes of candlestick patterns. We looked at the bullish class and the bearish class. So if you've not seen the video, just check the description box below so that you can go and see the video. Then you come over to this one. This is the part 2 of that video. Cheers. All right, so we'll be looking at, this is a Euro USD chart, the daily time frame of Euro USD chart. So we'll be looking at we'll be using this to explain the strategy, the part 2 of this strategy, which is also the final part of this strategy. So I would like us to get something. This strategy works well on a trending market. What I mean by a trending market is a market that is either going up or down. We have 3 types of market structures. We have the trending markets, we have the ranging markets, and we have the choppy markets. But we are not here to discuss about market structures. I just had to brief us on that. So what we'll be looking at today, is I'll just explain how you can determine a trending market, then apply this strategy to it. Now, for a trending market, just like I said initially, is a market that is either going up or down. So let's look at this Euro USD chart. If you look at it here, it's going down. See, it's not difficult to determine a trending market. It's not very difficult. Once you just open your chart, you can see it. From here, from this point, some traders normally use trend line. They use trend line to determine a trending market. So from here, you don't need to tell you that this is a downtrend market. So this is a downtrend market. You can use your trend line to determine that, or you can as well. There's we can use the concept of higher highs, higher lows, lower highs, lower lows to determine a trending market. Now, for a downtrend market, a downtrend market is characterized by lower highs and lower lows. The upper part of the candlestick pattern is referred to as the highs. The lower part of the candlestick pattern is referred to as the lows. I take that again. The upper part of the candlestick is referred to as the highs. The lower part of the candlestick is referred to as the lows. Now, this is what makes up a downtrend market. It is characterized by the formation of lower highs and lower lows. So as we can see, there is a high here,
there is a high here, there is a high here. So if you notice, during the course of this movement, the highs we are getting lower in height. This high here is higher than this one. This one here is higher than this one. This same one is higher than this one. So if you check, if you notice, during the course of this of the market movement, the length of the highs we are getting lower. Now let's also look at the lows. Remember I said the lower part of the candlestick makes up the lows. Yeah. Here. So these are the lows. These are the lows. And if you check, the lows we are getting lower as during the course of this market movement. So that is why in a trending market, we have two types of trending markets, the downtrend market and the uptrend market. On a downtrend market, it's characterized by the formation of lower lows, because the lows keeps getting lower and the highs too keeps getting lower. That is just it. And just like I said initially, a trending market is very, very easy to figure out. Once you just open your chart, you'll see it. Like just like what happened here. With the way this market is moving from here to this point, I don't need anybody to tell me that this is a downtrend. It's very clear. It's a clear downtrend. So this is a clear downtrend till this point. Then the market started having a pullback. Now, let's look at this one again. Now, this is the current market movement. Now, if we look at this current market movement, I don't need anybody to tell me that this is an uptrend. Euro USD is currently on an uptrend. It's a fact. It's currently on an uptrend. So that is how you determine a trending market. It's very simple. It's very simple. So if we look at this trending market now, if you look at the highs, remember the highs is the top of the candlestick, the lows is the bottom of the candlestick. So if you look at the top of the candlestick, if you notice, they keep increasing in height. They keep increasing in height. This is the first. This is the second. This is the third. So if you notice, they kept increasing in height. That is what makes them an uptrend market. The highs keeps getting higher. The highs keep getting higher. In an uptrend market, it's characterized by the formation of higher highs. And it's also characterized by the formation of higher lows. So if you look at the lows of the candlestick, they keep getting higher. So this is the low here. We also have a low here. So if you notice, the second low here is higher than the first low. So that's why an uptrend market is characterized by the formation of higher highs and higher lows, while a downtrend market is characterized by the formation of lower highs and lower lows. So it's just very simple to figure out. So in a trending market, there is what we refer to as turning points. There's what we refer to as turning points. Now, we would like to mark out these turning points. These turning points are very simple. It's just where the market had a turn, had a reversal. So here is a turning point. Here now is a turning point. So if you notice, the market got here, it turned, it went up to this point before it continued this downward movement. Came here too, went up here before it continued the downward movement. So that is a turning point. This too is a turning point. Here too is a turning point. Here too is a turning point. Same as this one. So now this is how you use this strategy. When you launch your chart, the first thing you look out for is the market structure. Is this market going up or down? Remember, like I said initially, this strategy works best on a trending market. And I believe that trending markets are one of the best market conditions that favors traders the most. So even me, I look at mostly for trending markets. I barely look into all those ranging markets. So when you launch your chart, you look out for the current market structure. If it is a downtrend market, be marking out the turning points. The turning points are areas where the market had a reversal to the upside for a downtrend market. So now we are considering a downtrend market and we've marked out the turning point. Now I need you to observe. Because this is where our strategy will be applied. Please pay attention to what we are about to consider now. Pay rapt attention to what we are about to consider now. This is a turning point. Now this is a turning point and it broke here. Now look at what happened. The market got to this turning point. If you could recall, this is a bearish engulfing. If you could recall from our first video, from the part 1 of this video, this is a bearish engulfing. Now the market got back to this turning point, gave a bearish engulfing, and what happened after that? The market sold. I take that again. This is a turning point. Remember, we said that for a downtrend market, turning points are points when the market had a reversal to the upside. Some people can make that mistake of calling this a turning point. Yes, this is a turning point, but it depends on the current market structure. If you are considering a downtrend market, if it is a downtrend market, focus on the turning point where the market went to reversed to the upside, where there was a pullback to the upside. Forget about the turning point where the market had a continued east downtrend like this one. You don't consider this. Forget about this one. So I'm deleting it. Again, if you have any question pertaining this, you can drop your question in the comment section and it will be duly attended to. So we look at this again. This is a turning point. Now, the market came down, reversed and touched this turning point. And when it did, what happened? The market sold. It touched this turning point and with a bearish engulfing candlestick pattern. This is the bearish engulfing. The bearish engulfing candlestick pattern. After the formation of this bearish engulfing, what happened? The market sold. We'll look at another example again. So this is another turning point. This is another turning point that we are considering. This one here. Let's look at what happened. Okay, see it here. So this is another turning point, and as we can see, the market came here, gave another bearish engulfing candlestick pattern. What happened after that? The market sold from here to this point. This is another candlestick pattern. Okay, here is where the candlestick pattern from. So this is another swing point. This is another turning point. You can call it a swing point or a turning point. So this is another turning point. here is another turning point. Now, the market came here and gave a shooting star candlestick pattern. Gave a shooting star candlestick pattern. And what happened after that? The market sold. Now, we notice that at 3 turning points here, remember, what we first of all did was determining the market structure. We noticed that yes, this is a trending market, this is a downtrend market, and we are looking out for turning points where the market had a pullback to the upside, and we marked it out. We are now waiting for the market to retest or come back to any of these turning points, and when it gets to any of these turning points, we await the formation of a bearish candlestick pattern. Here we are looking out for either a shooting star or a bearish engulfing, and as you can see, on 2 good occasions where it gave us a bearish engulfing at turning points, the market sold. At another occasion where it gave us a shooting star, the market still sold. So this is a simple strategy that you can use for your trading. It's very simple. It is very, very simple. If you don't understand any of this candlestick pattern, please check the description box below so that you can go to the first video and learn about these candlestick patterns. We didn't discuss much candlestick pattern. We just looked at 2 classes of candlestick pattern that are needed for this particular strategy. So as we all can see here, at any of these turning points and this candlestick pattern forms, the market sells heavily. So this strategy is very simple. The first thing you need to look out for in these strategies, understand the direction of the market, if it is a downtrend market or an uptrend market. Secondly, mark out the turning points. Mark out the turning points. Thirdly, wait for candlestick patterns formation. These are the 3 things that you are looking out for in this strategy. I take that again. Understand the market direction, whether it is an uptrend or a downtrend. Secondly, mark out turning points. Mark out your turning points. Thirdly, wait for candlestick pattern formations at those turning points. So when you get a candlestick pattern formation at those turning points, you do what? You execute your trade. Now, one might ask, where should be my stop loss? Fine, that's a very good question if you have such. So this is how you execute this trade. At the end of the formation of the bearish engulfing, let's say this is a bearish engulfing, I want to take this trade. Once this bearish engulfing ends up forming, you enter your trade. Your stop loss will be at the end, at the top of the bearish engulfing candlestick pattern. At the top, that's where your stop loss will be because you are selling. That's where your stop loss will be. Then same thing applies here. It closes here, you enter your trade, your stop loss will be here. Your stop loss will be here at the top of the bearish engulfing. Then your take profits will be let's say at the first support, at the closest support. That will be your first take profit, so which is here and here. So normally your take profit should be at the next turning point, so which is usually here. But you don't necessarily need to wait for the market to get here. You can take partials, you can break even as the market proceeds, because no one controls the market. You may be waiting for the market to get to the next turning point and it will just reverse and leave you there. So that's why you experience cases whereby a trade that was once running in profit ends up running at a loss. So you may not want to experience that. So your stop loss will be at the end of the candlestick. Then your take profit should be at either the first closest support or the next turning point, which is usually here. Now for a shooting star, after the formation of the candlestick, you enter your trade. Now your stop loss will be at the end of the wick of the shooting star. Then your take profit should be at the closest support, as we normally do that. So that's just it. It's very simple. So this is for a downtrend market. Let's look at for an uptrend market, because currently Euro USD is an uptrend market, and it will most likely buy from now to the middle of this year. So the uptrend market started from here. The uptrend market started from here. Now, for this uptrend market, okay, let me delete these ones that we use for the downtrend market. So this is the current market condition. Please note, the conditions outlined in this strategy must be met before you execute your trade. Don't just go and start taking trades at any turning points. No, you must wait for confirmation, and your confirmation is the candlestick pattern confirmation. Once you get your candlestick pattern confirmation, that's where you are meant to enter any trade. Once there is no confirmation, do not enter the trade. Okay? So, okay. So we had a turning point here. We had another turning point here. We equally had another turning point here. Now, if you look at it, okay, the turning point we had here, we didn't really get any reversal to it. So, but look at this turning point here. The market came here, touched it. So if you could recall, from our first video, this here is a bullish engulfing. If you could recall, this here is a bullish engulfing, and it formed at this turning point. And what happened after the formation? The market bought. See, like this market bought from here. Let's measure it. So the market bought from here. Wow. Nearly 400 pips. Nearly 400 pips. So it met this turning point here, gave a bullish engulfing, and it bought heavily. So you see that this strategy is very simple. It's very simple. It's just for you to be marking out. What you just need to do is just wait for, and again, you use this strategy with patience. Don't go and start applying this strategy on a choppy market or a ranging market. Use it on just trading market. Wait for when the market is trending. Then mark out your turning point. When you mark out for your turning point, wait for the market to get to any of your turning points. When it gets there and gives you any candlestick pattern formation, what you just need to do is just enter your trade. Put your stop loss at the end of the candlestick pattern and allow the market to do its thing. And 80 to 90% of the time, this plays out, provided you use it rightly, just like we explained on this video. So on your writing materials, put this down. First, understand the market direction. If it is a trending market, understand whether it is an uptrend or a downtrend. Secondly, mark out your turning points. Mark out your turning points. Thirdly, wait for the market to get to your turning point and give you any of the candlestick pattern formation. If you get any of the candlestick pattern formation, okay, and again, for a bullish, for an uptrend, the candlestick pattern formation you should be looking out for is either bullish engulfing or a hammer. Bullish engulfing or a hammer. For a downtrend market, the candlestick pattern formation you should be looking out for is bearish engulfing or a shooting star. So if the market is an uptrend, look out for either a bullish engulfing candlestick pattern or a hammer occurring at any of your turning points. If it is a downtrend market, look out for either a bearish engulfing candlestick pattern or a shooting star at any of your turning points. Once this occurs, do not overthink it. Do not overthink it. Just do what? Execute your trade and put your stop loss at the end of the candlestick pattern. Then allow the market to decide. Again, I also need to talk about the time frame. This works best on a daily time frame, 4-hour time frame. Yeah, just target it at daily and 4-hour time frame. Then you are good to go. And you determine your market direction from the weekly. You start from the weekly or monthly and also to the daily. It gives you an overall view of the market direction. Once you get the overall view of the market direction, either an uptrend or a downtrend, then you are good to go. Once you determine this, the next thing you have to do is just to mark out your turning points. When you mark out your turning points, you wait for the market to get to any of your turning points and give you any of the candlestick pattern formation we discussed. Remember, I will take the steps again. Determine the market direction. If it is an uptrend or a downtrend. Secondly, mark out your turning points. Thirdly, if the market is an uptrend, look out for either a bullish engulfing candlestick pattern or a hammer at any of your turning points. If the market is a downtrend, look out for either a bearish engulfing or a shooting star at any of your turning points. Then you are good to go. This is just the simplest way to apply this strategy. You can backtest this. Look at other historical data on your chart and backtest this strategy on it. Then you confirm that yes, this strategy has a good win rate. You don't need all those it's not like smart money concept or ICT where you have to learn a whole lot of concepts, bend this, bend that. No, this is very simple and straight to the point. Okay, so just pay attention to this, and also you can watch this video over and over again. If you have any questions, drop it on the comment box. We are definitely gonna reply you. We are definitely gonna respond to any of your questions. Okay, because we actually want you to be successful in everything you're doing, especially while trading the financial market. So if you have any question, feel free to ask. Also, don't forget to subscribe to our channel and also hit the thumbs up button so that this video will become more visible to a whole lot of traders out there, because you may be doing someone a favor by letting them know about this simple trading strategy. The reason a whole lot of traders are not profitable in the market is because they are exposing themselves to a whole lot of strategies. Only one trader is trading price action, ICT, beat the market maker. No, you just need a simple strategy. Trading is not meant to be stressful. Whenever you open your chart, you should have just few things you should be looking out for. And when you see any of those things you're looking out for, just execute your trades. Just execute your trade. Put your stop loss, put your take profit, go about your daily activities and let the market decide. So it's very simple. So I'll be out there to respond to any questions that you will be having. Don't forget to check out our website to see what we have to offer there, and also join our Telegram channel so that you can be getting market updates and also analysis and signals on our Telegram channel. Also, don't forget to follow us on Instagram too. And don't forget, most importantly, don't forget to subscribe and also hit the thumbs up button so that this video will become more visible to a whole lot of struggling traders out there. I'll be seeing you on the next video where we're going to talk about trading psychology. Because yes, this strategy alone cannot make you successful in the market. You need to master how to handle your emotions. So that's what we'll be talking about on the next video. See you there. I hope to see you on the next video. Before then, do well to subscribe and give this video a thumbs up. Cheers.